Welcome to Stock Wars. This battle between dividend stock combatants will determine who seizes galactic supremacy and is the most attractive utility sector company going forward. The first Stock Wars combatant is Southern Company. Southern Company was incorporated in 1945 and is headquartered in Atlanta, Georgia. The company serves approximately 8.6 million electric and gas utility customers. Southern Company, through its subsidiaries, engages in the generation, transmission, and distribution of electricity. It operates in 4 segments: gas distribution operations, gas pipeline investments, wholesale gas services, and of course gas marketing services. The company also constructs, acquires, owns, and manages power generation assets, including renewable energy and battery energy storage projects, and sells electricity in the wholesale market. It distributes natural gas in Illinois, Georgia, Virginia, and Tennessee, as well as provides gas marketing services, wholesale gas services, and gas pipeline investment operations. The second combatant is Duke Energy. Duke Energy was formerly known as Duke Energy Holdings Corporation and changed its name to Duke Energy Corporation in April 2005. The company was incorporated in 2005 and is headquartered in Charlotte, North Carolina. Duke Energy operates through 3 segments: electric utilities and infrastructure, gas utilities and infrastructure, and commercial renewables. The electric utilities and infrastructure segment serves approximately 7.8 million retail electric customers in 6 states in the Southeast and Midwest regions of the United States, covering a service territory of approximately 91,000 square miles. This accounts for approximately 51,144 megawatts of generation capacity. Let the battle begin. Southern Company is currently trading at $66.19 and is up over 23% year to date. Over the last 5 years, Southern Company is up over 33%. Duke Energy, our other utilities titan, which is trading at $101.09, is up this year, seeing an increase of just over 25%. With that said, Duke Energy is up over 26% during the last 5 years. Now let's take a look at which combatant may perform better going forward based on its current valuation. The first item to compare is market cap. Market capitalization, commonly called market cap, is the market value of a publicly traded company's outstanding shares. Market capitalization is equal to the share price multiplied by the number of shares outstanding. Market cap is probably the least important metric in Stock Wars, but it is an indicator of public opinion of a company's net worth and is a determining factor in some forms of stock valuation. From a market cap perspective, Duke Energy is the larger company with $77.3 billion compared to $69.9 billion for Southern Company. Both are utility company favorites, but Duke Energy takes the first metric comparison in the Stock Wars battle with $7 billion more in market cap. The second Stock Wars metric comparison is revenue. Revenue is the income generated from normal business operations. It is the top line or gross income figure from which costs are subtracted to determine net income. Who generates more revenue in this epic Stock Wars showdown? In 2020, Southern Company had $20.37 billion in revenue, while Duke Energy came in at $24.02 billion in revenue. Duke Energy wins the second consecutive metric in this battle against Southern Company. The third metrics comparison in Stock Wars is further down on the income statement: net income or profit. Profit describes the financial benefit realized when revenues generated from a business activity exceed the expenses, costs, and taxes involved in sustaining the activity in question. For the first time in this Stock Wars battle, Southern Company takes the win with $3.11 billion in profit. while Duke Energy came in at $1.26 billion. Southern Company takes this metric in this epic stock wars battle. Knowing the profit for each combatant transitions to the next metric in this stock wars comparison: profit margin. Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or business activity makes money. It represents what percentage of sales have turned into profits. Southern Company comes in with a profit margin of 15.26%, while Duke Energy is at 5.24%. For this metric, Southern Company wins. Both companies have decent profit margins, which is normal for companies operating regulated utilities. As the stock wars rage and we are at a 2-2 stalemate, the fifth metric is in sight: 3-year revenue growth. Revenue growth illustrates sales increases or decreases over time. It is used to measure how fast a company is expanding or contracting. Southern Company comes in with a 3-year revenue growth of -5.7%, while Duke Energy wins another metric with a 3-year revenue growth of -1.3%. As the two utility behemoths battle for dominance, P/E ratio emerges as the sixth metric in stock wars. The price to earnings ratio is the ratio for valuing a company that measures its current share price relative to its per share earnings. The price to earnings ratio is sometimes known as the price multiple or the earnings multiple. When examining the forward P/E, Southern Company comes in with a metric of 19.97, while Duke Energy boasts a forward P/E at 19.36. Duke Energy comes out on top for the fourth time in this stock wars matchup. As the battle rages between these two utility companies, dividend yield is the next metric comparison in stock wars. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Southern Company comes in with a dividend yield of 4%. Duke Energy, on the other hand, is at a lower 3.84% yield. For the second time, Southern Company wins a stock wars metric. Both yields are pretty decent. Continuing on, the next metric is years of consecutive dividend increases. Companies with a track record of dividend increases tend to be more stable and motivated to maintain that track record. When analyzing the two combatants, Southern Company boasts 19 years of dividend growth, while Duke Energy comes in at 10. In this metrics battle, Southern Company comes out on top. Now on to 5-year dividend growth, which is the next metric in the stock wars battle between these utilities leaders. The dividend growth rate is the annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. Many mature companies seek to increase the dividend paid to their investors on a regular basis. According to Fidelity, Southern Company has a 5-year dividend growth rate of 4% compared to Duke Energy at 3.18%. Southern Company claims the metric in this stock wars matchup. This begs the question for our next metric: how safe are the dividends? The Dividend Safety score system takes into an account more than a dozen fundamental metrics that influence a company's ability to continue paying dividends. According to Simply Safe Dividends, Southern Company has a score of 65, which is considered safe. On the other side of this matchup, Duke Energy has a score of 80, which is also considered safe. Duke Energy is the winner of this stock wars metric. The 11th metric in this stock wars contest also reflects on dividend safety: the payout ratio. The payout ratio is a financial metric showing the proportion of earnings a company pays shareholders in the form of dividends. This is expressed as a percentage of the company's total earnings. Currently, Southern Company's payout ratio is 83.02%, while Duke Energy is at 74.66%. Both payout ratios are creeping up there, but Duke Energy is the winner of this Stock Wars metric. Moving on quickly to the 12th metric, the two utilities titans will compare current ratios. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize its current assets on the balance sheet to satisfy its current debt and other payables. Southern Company comes in with a current ratio of 0.71. Duke Energy, on the other hand, sees its current ratio at 0.53. The higher the current ratio, the better. Therefore, Southern Company takes this Stock Wars metric with a slightly higher current ratio. The last metric is the debt-to-equity ratio in this Stock Wars contest. The debt-to-equity ratio is calculated by dividing a company's total liabilities by its shareholder equity. These numbers are available on the balance sheet of the company's financial statements. Southern Company sees a debt-to-equity ratio of 1.81, and Duke Energy comes in at 1.34. While both are well over 0.5, which means their assets are financed by debt, Duke Energy gets the better of this metric and wins this one. In this Stock Wars battle, Duke Energy won 7 metrics compared to Southern Company, who won 6. Duke Energy is the winner of this epic Stock Wars battle between these utilities sector favorites. Duke Energy wins this overall Stock Wars battle from a metric standpoint, but the battle is relatively close between these popular utilities giants. That being said, both companies are modestly overvalued at the moment. Many consider utility stocks as the modern-day bond. If you missed the first 9 episodes of Stock Wars matchups, please check them out and let me know what you think. I'll leave links in the description. Stay tuned for future Stock Wars episodes, and please like, subscribe, and turn on the bell notification so you don't miss any future episodes. Comment below if there's a particular battle you'd like to see. Until next time. Remember, I am not a financial advisor. The opinions expressed in this video are solely for educational and entertainment purposes. Any stock purchases I show on video should not be considered an investment recommendation. Investing involves risk, and you should do your own research. For investment advice, please seek the counsel of a financial investment advisor.